Howdy, folks. Welcome to this week's edition of Planning for High Earners. Now, I'm Mark Newfield with Journey Strategic Wealth. It is that time of year again, especially if you're a sports fan. We've got the start of college basketball, we've got baseball playoffs, we've got hockey, we've got college football, we've got professional football. So sports junkie heaven. That's not actually what this conversation is about. It's also the time of year when many of you are finalizing or thinking about charitable contributions. There are a number of ways to make charitable contributions. You can give cash, you can give property, either publicly held or privately held. You can use a donor advised fund. You can use charitable lead or charitable remainder trusts or a family foundation. So it's actually a fairly complicated part of planning, even though the object is simple. Hey, I want to benefit a charity, be a charity, I have charitable intent. The two techniques that we see the most often are the giving of appreciated securities and the use of donor advised funds. Both of them can be very effective. The most effective use of donor advised funds that I see is when, by bunching contributions, you can leverage the tax code in a given year, say a year when you have very high income, or a year when you might not itemize, barring the making of charitable contributions. And by that, I mean, let's just say that you gift to a variety of charities $40,000 a year. And for whatever reason, you have the capacity to make a $200,000 gift this year, but you don't want to distribute that $200,000 all in one year, but you want the charitable contribution. And again, you have the tax capacity to make a contribution of that size. Fine, make it to a donor advised fund and distribute it at $40,000 a year over the next 5 years. Accomplishes both goals. Now, if you have a taxable investment account and you have appreciated securities, gifting of an appreciated securities is very effective. Let's just say that you have $20,000 worth of Microsoft. Its cost basis is $10,000. And therefore, if you sell that stock, you have a $10,000 capital gain. Well, gift the stock to the charity instead. They get the utility of the $20,000. You get a $20,000 tax deduction, and you've wiped out a $10,000 gain at a 15 or 20% tax rate. Put another way, you sell to Microsoft for $20,000. If you're in the 20% bracket, you get $16,000. Either the charity ends up with $16,000, or you have to fill in the $4,000 to get it to $20,000. So a couple of useful tools, simple, anybody can do them. You don't have to have a lot of money to do it. It does take some tax planning. And usually it's useful to have a CPA engaged in this. You can do it yourself. The tools are out there. But in any case, something to think about as you're considering charitable giving for the year. I hope this finds you well, and I hope you have a fabulous week.